All right, hello everyone. So today's the 31st of January. Now, I'm not going to trade today because Friday, I don't work on Friday, so I'm not going to trade. But let's take a look at really what happened in January. So we're doing the challenge, right, for 3 months. Why is this important? It kind of like gives us discipline. It's helped me out a lot, despite the fact that I've been trading for quite a long time. Our psychology is always changing. So because we're always going through ups and downs, to maintain it, a good idea is, your trading journal, okay, like this one. And also, let's check out what happened. So we started in January, and as with all of them, let's do this. So let's start with the 6th of Jan, right? So the swing days were Monday, Wednesday, and Friday for gold. Euro dollar Tuesday and Friday. Let's take it one day at a time. Okay, so gold, Monday, Wednesday, Friday, starting on the 6th of Jan. I didn't do anything until the 6th of Jan because we just got back from the holiday and like a New Year's break. So I just thought, you know what, past the weekend, and let's just take it from there. Now let's push it back. This is the 31st. So if I go all the way back into the 6th, okay, I'm just going to do gold so you can check out everything else, okay? So this is the 6th of January, right? So this is Monday, 6th of January. Here we are. Market makes a low. It goes up into Wednesday, okay? Falls down. So Wednesday, it was also a swing day. Wednesday could have been from the low as well. Why? Because Tuesday went big down. So Wednesday was a good day to also buy again. All right. So Monday market makes it. Wednesday returns again and goes all the way up into Friday. Friday is a swing day, right? On the next one. So let's take a look at the next one. Not this one, but this one. Okay, so that's Monday, Wednesday, Friday for the 6th to 10th of Jan. Let's take a look at the 13th. Then we've got Monday and Friday being a swing day, right? So then this is Monday. Market rockets down, okay? Flies down on Monday. So Monday essentially is a swing day on the high and on the low. Then, because the trend is going up, remember, Monday starts there, goes all the way into Friday, pretty much. And then Friday is a swing day. Friday is afterwards, as you can see, a big sell all the way into Monday to the 20th. Let's see what happened on the week of the 20th. Where is the week of the 20th? 13 to 17. Okay, let me grab that. Okay, so this is the 20th to the 24th. Gold swing day, Tuesday, Thursday. Okay, so let's take a look on those days. On the 20th, that's 20th of January here. Let's pull this down here a little bit. Okay, so market, swing day Friday, market comes down into Monday. Monday, market picks up a little bit, okay, going sideways. And Tuesday, there you go. Tuesday is when your big push up there, okay? So Tuesday, that's your Wednesday, okay? Market back down on Thursday. So Thursday being a 2-day, all right? Coming all the way down. And then on Thursday, whoop, here we are, going back up again into the 24th, all right? So if you just trade on the swing days, you should have been just fine because those days were setup days. Even if you miss a swing day, what happens is the next day you wait for a retracement, or the day after you wait for a retracement. Why? Because according to our technical analysis, remember, once we got the impulse on the pullback, you can still enter because we've got the hours for the days as well. So the setup is like this. On a trade day, I'm thinking, okay, we're either going to reverse or we're going to set up somewhere for a reversal. So Tuesday and Thursday, and then the next ones after that was 27. That's Tuesday and Friday, the week of 27 to the 31st. Tuesday, Friday, let's take this down. Then this is your Tuesday. All right, this is the last week. That's your Tuesday. I wasn't expecting it from here. I was expecting it slightly lower. It didn't happen. So I actually missed out on this one, which is precisely brings me to that again, the retracement. And this is the time we had the FOMC. All right. And I said the market could buy from here. That's in London. Okay. And I had a trade in there. Then this was like New York. And this was FOMC in the evening time. All right. So the market was doing all this chop chop move. Here I actually got stopped out, but I understood we need to buy. Okay. And that was the important thing. Why? Despite the fact that I was stopped out here, I was okay here, I was okay here, but here I got stopped out. Okay. And that does happen. But I understood that after the impulse, we got to be buyers, because that's the reaction here, as you can see, which is breaking out in New York. So immediately yesterday I bought here and we just followed it up. Okay. And then I got out. Okay. And that finalized my January. Now, if you look at all the assets, kind of like figure out the swing day and how I can settle in with my technical analysis to swing hours, the vertical lines, then obviously things are going to look much better for you, right? Then you got levels to buy, levels to sell, levels to exit, and so on. So seeing this as a trading hour before London opened, that's London time. Okay, this zone is London morning. This is New York morning. So I figured, oh, if this is the trading hour, this is, if we get in early, we're going to be the early bird gets the worm kind of thing. And then it's exactly what happened, and just didn't need to touch anything until 2,777, because that was the high and that was like it. And then it was my evening anyway. So I closed the trade, called it a day, called it a month, since I'm not trading today. Now, okay, it wasn't a bad month. Okay, it wasn't a bad month at all. As you can see, overall, it's not bad. I think overall, I've got like 57% success rate on the latest one, which I did. I posted it on social media as well. Okay, so you can probably see it on, let's put it up here so you can see it actually. Okay, this is on Twitter, right? So as you can see here as well, it's I took total 69 trades. Okay. 57.97. All right, so 58% win rate, but the account is in good position. It's in good shape. Okay, I had a bit of a drama when I first started in the first week. Okay, but afterwards it's just like picked up the pieces, kind of like got back from the holiday and so on. All right, now what's important here is this. The important thing is to make sure we're consistent with the trades and how we're approaching it. Okay, so when you take like technical analysis and the timing and stuff, you've got to bring them together, and this is not going to happen overnight like that. And the reason I also have 57% isn't an excellent or great in our eyes as a success rate, but you got to understand I'm taking 2 positions in every trade. I always open 2 positions. So 2 positions for me is actually 1 trade. So overall, I didn't take 69 trades or 70 trades. I took 35 trades, because I'm always taking 2 positions at the same time. 1 to cover the stop, 1 to run. Okay, so this is how it's working out for me. And this is why it looks like I've got a lot of trades, but I don't trade that often. In fact, because we've got the challenge, I kind of felt compelled. I've got to do something and show examples and so on, which I did also in the members area. Okay, but generally what we should do to trade nice and safe is to check up our setups on swing days, swing hours, and your technical analysis setups. Once you've got those things settled in, the rest is money management, and you can see more often than not the market is on our side, because the timing works really well. Here as well on the euro dollar, on Thursday I took a trade, Wednesday, and that was right before the FOMC. Look there. This was before the news. This is 3:30 my time, which is 7:30 a.m. in New York. So this was like way before the markets even started trading, doing anything. But this was the hour. So as soon as I got in, the trade already covered itself, because I only put like 10 pip stop loss. 10 pip stop loss as in if I entered the trade, let's say at 1.0394, at 1.0384, I had my stop loss. Okay, so it was a nice and tight, because I understood if I'm wrong, okay, because I entered somewhere here, okay, the bar closed and I entered after the timing bar closed, and it was something around here. I said to myself, you know, if I'm wrong, I don't need to be in this trade. Okay, this is why the stops are tight. And sometimes what happens is we get things right, okay, and then, like for example here as well, look, I entered a trade here as well, and I wanted to take the euro dollar up. This is not the best of places because it was a sandwich zone, okay, between the weekly and so on. But as you can see, the market, you know, went down a little bit. I didn't get stopped out here as well because it's still tight stop loss, but under the white line, obviously. And then it went up into the daily pivot. Now, because I entered here, but the market turned around here, okay, I got out of the trade as soon as I made just very small profit. I was actually happy to get out with zero profit or even very, very small loss. Why? Because if I didn't enter a trade at the right time and price according to my calculation and the market, then, you know, you can get out of that trade. And the reason I did get out of that trade because we had news coming out for the euro. So I said to myself, let me get out of this, okay, and not risk anything. And then if I want to trade again, I can come back into that zone and so on. So this is before the news, euro dollar. This is the news. You see how it's all going with the timing, and it's not just going, you know, according to the news. It is timed very nicely. And then the market goes up. Okay, you could have taken your profits there because it's news. We're expecting spiky news. And I did say yesterday in the video too, I'm expecting volatility with the news. Same with the FOMC as well. So the volatility did happen, and then the market came back down. Okay, and that's how it is. And this is also, look, the trading hours here. So the market falls back down, retraces, messes around the weekly pivot, and then boom, sells down again. Just boom, crashes down. So it's worthwhile, you know, keeping this timing thing in mind. And if you're going to do anything, it's obviously best to do it with a tight stop loss. Okay, and because I've got two positions open, if a trade does turn sour, it's like I've lost two positions. That's why the statistics can sometimes be low, but that's not the point. The point is the bottom line. Okay, so are we consistently going up? Because this is how it should be looking like, really. You see the losses are very small, okay, and we're going up. The losses are small and we're going up. And that's how it should be, all right? This was like, when I first started, I was like, needed to take a trade because it was the challenge. So I better put a few trades in, which is not a good idea. But still, at the end of the day, once I, you know, kind of like got back into my routine, it went up. And this is what we need to do. We need to establish a routine. So we use the 5 steps in the technical analysis that we learn, right? Use the 5 steps, sort it out, add the timing, bingo. I hope this helps. So hopefully we'll get into trading again on Monday, and that's going to be our second month of February. And I also would like to note that actually they're also testing out our timing at the Chicago Mercantile Exchange. So yesterday I had a chat with a guy there. They're going to also enter a challenge. They got their own challenge as well, apparently, and they've got their own assets that they're trading. So they're going to use our timing as well to time the trades to see how it's going to work out for them. So it's good to know that people are picking up on it as well. In the interim, have a good weekend, and hopefully we'll carry on if all goes well on Monday.